11,400 crore banking fraud has brought the spotlight back on public sector banks. Now, while there are questions asked about corporate governance standards and lapses in the system, what does this really mean for allocations, especially for thematic banking sector funds? For that, we get you a fund manager's view from Sanjay Parekh, who joins us on the phone line. He's a senior fund manager for equity investments at Reliance Mutual Fund. Sanjay, thank you very much. Appreciate you having agreed to speak to us here at Bloomberg Quint. Before I can just ask you, the questions that I have for you, just want to address Reliance Banking Fund holdings as of 31st January 2018. They have an exposure to two PSU banks, which forms about 8.6% of their portfolio. Their exposure to private banks stands at 53.5%. Exposure to NBFs stands at about 27%, and the remaining 8 to 9% to insurance companies. So Sanjay, this is the holding picture as of 31st January. Just want to understand how this portfolio allocation has changed since then, or more specifically since 13th February when the Nirav Modi PNB fraud came to light.
Yeah, hi, good morning to all of you. Thanks, Srita, for giving us an opportunity. So, the way we classify it, I'll explain you as of 31st Jan, because we can't be talking about February. So the way we were positioned was that what we call as private retail banks with less asset quality issues. As you would know, the HFC banks of the world, the Kotak, and of course, we classify even Bharat Finance because it's getting merged into IndusInd Bank. So all of them put together is 42% for us. The corporate banks, the large corporate banks, the SBI, Axis, BOB, and ICICI, all of them put together we have 20%. Insurance, the life insurance, we have 8.5%. Housing finance companies, the top end housing finance companies, we have 7%. NBFCs, we have 11%. Old private banks, we have 6%. And then a small holding to rating agency, and the rest is cash. So this is the positioning as of 31st Jan. Of course, we would have made some changes, but broadly, the way we think about it is that, this issue is certainly issue. Just a second. Yeah, this issue is certainly painful, and it does, cause the ripples, as you would have seen. But more than that, even the RBI guideline which came through was important. Broadly, we have a credit of 80 lakh crore, and 10% of that was gross NPA, which was under IBC or other than IBC. And another 4 to 5% was under RBI dispensation, stroke watch list, stroke SMA2. Now, there could be small overlaps, but in this second bucket, there would be accelerated provisioning requirement by the RBI guideline. Because as per the guideline, about 2,000 crore accounts, if the resolution is not in place as of 1st March, then they move to NPA, and then within 6 months they move to NCLT. And if they move to NCLT, that would mean increased provisioning requirement. So that bucket, the provisioning has to increase for sure for all corporate banks. So that would, to summarize, these guidelines would mean higher movement of assets from RBI dispensation to NPAs, higher provisioning, and that would mean higher credit cost in Q4 and FY19 and lower return ratios.
Correct. So Sanjay, what I was trying to understand here is, I understand you can't talk about what exactly you've done with your fund holdings in February, but just trying to get an idea if you're looking at this as an opportunity to add, given that the shares of PSU banks and even aside of PNB have corrected by a good 15 to 20%. So are you seeing this as an opportunity to add, or you have a contrasting view? Just want to understand what you're doing with your holdings in PSU banks, or on the other hand, do you see that it's only going to become more difficult for them, or for that earnings growth that everybody has been waiting for? So or are you trying to reduce your holdings because they could act as a drag on the overall returns?
Yeah. So, Mashada, while we may not be, it will be difficult to spell out what we're exactly doing, but I'll tell you the broad strategy we're following. And that's where we focused on that, and we've been consistent on it. So we like private banks with less asset quality issues because there the risk is less. They're very strong franchisee, both on the asset and liability side. They are gaining market share and they're adequately capitalized. So those are clearly, showing up in our, in our fact sheet also. We are clearly overweight at 42%. Because less asset quality risk is where we've given a lot of premium in terms of our weightages. The second bucket is large corporate banks, extremely large corporate banks, be it PSU banks or even the private space, which has asset quality issues, but they've again very strong franchisee on CASA, on asset side, a very strong retail book. They're well capitalized, and the size of balance sheet is large, and they have subsidiaries which are doing extremely well, which they can monetize if required. So there is a headwind because of what I said earlier. And they would look, in the interim, they will have pain of higher recognition and higher credit cost. But we believe that, FY20 onwards, they would also look better because the retail piece would really get recognized, and large part of this accelerated provisioning would have been done in Q4 and FY19.
Sure. So the PNB fraud case, of course, has been widely reported, written about, debated, etc. So it has definitely dented the sentiment as far as the banking space is concerned. Has there been, or do you expect there to be any sort of an impact with respect to inflows into banking sector thematic funds specifically?
So, ma'am, it's, any thematic fund, one has to be having an appropriate weight. That is what we always have maintained, that these are thematic funds, and one should only have an appropriate allocation in terms of weightages. Secondly, we've always, in the recent times, said that, go gradual, do SIPs, because we've seen significant appreciation in this theme. And there was always scope for correction. And what we've done is we've managed risk, because finally banking is a leverage. So you're taking a bet on all the leverage. It's almost 10, 11, 12 times debt to equity. So we've managed the fund where the risk also, we've been very conscious while buying any of the banks, that it's not only returns, but risk also has to be well managed. And that has helped us, even in this fall, because, we certainly were much better poised in terms of our positioning of the funds.
Sanjay, good morning. This is Agam here here, and actually my question was to do with the NBFCs. We've seen a little bit of correction, which is why a lot of analysts in the market are suggesting that valuations are not steep anymore, and there has been some delivery with respect to growth. If you keep these factors into consideration, what is your reading of the situation, and what is your view on NBFCs then?
Yeah, so one is the housing finance company as an opportunity. We like that, but there also we need to be in the top of the line in housing finance companies who can manage the, clearly, as you know, the bond yields are going up. So if they are borrowing on the wholesale side in terms of the risk management on asset and liability side, they really have to be strong. And we like only the top end NBFCs. In terms of housing finance companies, in terms of NBFCs, again, we are very selective, and where the managements are very strong with strong business models, where they have retail presence and are very nimble on the liability side. And that is very critical according to us. And some of the asset-backed NBFCs also. But the critical point at this point is that they have to be really nimble to manage the interest rate environment, which is volatile.
Sanjay, Reliance Banking Fund has 25% exposure only to HDFC Bank. That's 1/4 of your portfolio. I just want to understand how this would be a good idea from a risk management and diversification perspective. I'm sure you have your reasons for the confidence in this particular bank, and I know you cannot talk about individual banks, but such a high concentration to one bank. Is this something to do with your strategy or bets as far as the private retail banking space is concerned?
Yeah, ma'am. So you have a fair point, but I'll tell you what as you know, we're benchmarked, right? So the benchmark has significantly higher weight to that stock. The benchmark is actually, based on which benchmark you take, it's 28 to 32%. So we do keep an eye in these portfolios also where the benchmark is, because ultimately we've monitored on beating the benchmark and of course on a relative basis, and also management of risk, because the particular bank you discussed very, very clearly has a very strong franchise, is managing risk quite well, is clearly gaining market share, very well capitalized, and over last 10 years and 15 years, you would have seen that gradually increased its share. And now it can, in this environment when, there would be a credit requirement in terms of credit growth, we see that, a lot of PSU banks would go, the smaller ones would hit the PCA guidelines and they'll not be able to provide credit. So the larger banks, which are well capitalized, will really benefit out of this. And that is why, our overweight, our exposure to this bank has been higher. In fact, as you see, we are underweight on that bank because we want to manage the risk well,
Okay, well, quite naturally, at least at this point in time, it's not always easy to talk about public sector banks, especially when you hold them. And for that, we are grateful. Sanjay, thanks for joining us and giving us your perspective.